If you're a Canadian business owner, I'm sure that you can agree Canadian business owners pay far too much in tax. My name is Fraser Orbrown, Senior Business Advisor with Approach Advisory and Associate Portfolio Manager at Cornerstone Fiduciary Wealth Management. Today, I'm going to share the top 10 underutilized tax strategies for business owners. Number 1, consider setting up an individual pension plan. First and foremost, if you're a business owner over the age of 40 who's making around $200,000 a year, the first thing that I like to suggest is to consider implementing an individual pension plan. An individual pension plan is basically like taking your RRSP and putting it on steroids. As opposed to providing a simple flat contribution to your RRSP, an IPP allows you to contribute an increased amount that scales with your age. This can lead to a deferral of over $1 million of taxable income by retirement, offers credit protection on contributed assets, a consistent income in retirement, and provides other significant benefits to both the owners and the key staff that are offered the ability to open one. An IPP can save you a huge amount of tax, allowing you to increase your income in retirement. Number 2, you might want to look at a retirement compensation arrangement. A retirement compensation arrangement is a tax deferral tool offered by the government, somewhat like an RRSP or an IPP. What it allows you to do is, as an owner or a key employee of a company, you have the ability to spread the income that you receive in a year over a number of years, and that number is generally up to you. The real benefit of this is that if you're planning on selling your company, prior to selling, you could split the income that you make over several years, allowing you to reduce your marginal tax bracket and pay much less tax over time. Number 3, evaluate how you pay for wealth management services and what you're paying for. An important consideration for tax purposes is what are you paying your advisor for and how is it being paid? Typically, the management expenses that you pay an advisor are not a tax-deductible corporate expense for personal accounts. Any expense that you cover from your corporation for you as an individual will be considered a taxable benefit. A strong argument you could make, however, depending on the service that you're offered by your advisor, is that you're not paying for investment management, but rather for financial planning for your business. If offered as a business owner's financial planning expense, this could allow you to expense the fees associated with the services offered and pay less tax each year on these costs. Number 4, pay yourself a salary versus dividends. Many accountants may not like the suggestion based on the strategies that worked prior to 2017. However, consider paying yourself a salary up to the amount that maximizes your RRSP room each year, and then pay yourself dividends afterwards. The downside of this approach is that you'll be covering your EI and CPP for both employer and employee share in that year. However, it opens up major tax savings through the ability to utilize two of the strategies that I mentioned earlier, and in the long term, the income that you should receive in retirement more than justifies it. Number 5, consider the use of insurance. Insurance is not simply a method of managing risks, but also a way of managing taxes. Income that you receive from an insurance product is not taxable, unlike normal income. This opens up a number of strategies that can be customized based on your situation that could save a boatload of taxes for the long term. Number 6, allocate your investments differently by account. Many people aren't aware that the income that you receive from your investments is taxed differently. Not only, but there are different sets of taxes that are applicable to certain accounts. If your accounts are all built the same, put simply with the same holdings, there may be taxes that you're paying that you weren't aware of, or there may be a more efficient way of holding the exact same investments. Allocating your investments differently based on the accounts that you hold could save you money in the long term without even changing the holdings. Number 7, use the equity in your home for long-term investment. This strategy isn't for everyone. Canadians tend to be very risk adverse and often like to pay their debt off as soon as possible, which is not a bad thing. However, for a long-term investor who understands the risks, there is an opportunity to use the equity in your home for investment purposes. By borrowing from the value of your home, you could invest the funds for the long term, and the interest that you would pay would be tax deductible from the investment income that you receive. Not much different from a rental property. However, please speak with both your accountant and advisor to ensure that you understand both the pros and cons to this approach before doing so. If appropriate and done properly, there is a tax-efficient income that you could potentially receive immediately. Number 8, Set up a corporate health spending account. As opposed to paying for any healthcare expenses out of your personal pocket, you might want to consider opening up a corporate health spending account. A corporate health spending account can allow you to write your healthcare costs off at the corporate level as an employee benefit. This could allow you to not pay personal taxes on your medical expenses. Number 9, consider using a family trust. With the changes to income and trusts, again, this isn't for everyone. However, there still may be many situations where a family trust could be advantage. If there are members of the trust who make a smaller amount than the contributor to the trust, the income that is received could be distributed to them and taxed at their lower tax bracket. Number 10, take advantage of a spousal loan. Similar to utilizing a trust, if your spouse earns less than you do each year, you may want to consider setting up a spousal loan. The income that you make in Canada is technically your money. It's not family money. However, you can lend it to your spouse, and by doing so, your spouse could then use those funds for investment purposes. At the same time, your spouse would pay you interest on the money that they borrow and write that off against the income they receive. This could allow you to equalize the tax brackets between the two of you, saving you tons of tax in the long term. Do you think that you're paying too much tax? Do you want to see if any of the strategies that I shared with you today apply to you? Call us for a free tax strategy review of your accounts or schedule a meeting at approachadvisory.ca. I look forward to meeting with you.